Hi, my name is Shreyans, and today we are going to do a basic financial analysis of one of the companies which has handsomely rewarded its shareholders ever since it got listed, right? But before we start, please remember that this is not investment advice. The purpose here is just to filter stocks for further research, right? So let's get started. The company that I'm talking about is Asian Paints. Now we all know Asian Paints is the leading manufacturer and seller of paint services, and it has also started providing related services like interior decor and design consultancy and stuff like that. So it doesn't only sell to households, but it also sells to automobile industry and also to industries where they need to paint their equipments, right? Now, before we move on to the highlights, first let's start with the financials and we'll look at the key metrics and growth as well. Now, starting with revenue. So, one astonishing fact here is that revenue, EBIT, and PAT, none of them have declined on a year-on-year basis in the last 9-10 years. And this is an astonishing fact. If you see here, the growth has always been positive, right? For revenue, for EBIT, for PAT, see all green dots here, right? And the revenue CAGR is about 11.3%. The EBIT CAGR is 12% and PAT CAGR is 13.6%. So this is also another highlight that the EBIT CAGR is greater than revenue CAGR and the PAT CAGR is even greater than the EBIT CAGR. Although the difference is not a lot, but still that basically means that the company is able to transfer efficiencies as it scales up. Right now, what's the concern here? The concern here is the fact that out of the last 5 years, the performance has been poor, right? So if you look at the median revenue growth, which is about 11.5%, then out of the last 5 years, in 4 years here, and this one as well, the growth has been lower than median growth and it's been single digit growth. And similarly with EBIT, we have the median is 11.1 and for the past 4 years, the growth has been lower than median growth, but still the FY19 is greater than 10%, so we can probably discount that. So FY17, FY18, and FY20 have not been good years. And again, if you look at PAT, the median growth is 12.7%. In these 3 years, it has been lesser than median growth, but these 2 years have been the poorer years, right? So in the last 5 years, I mean, the company seems to be, a bit challenged for growth, so to speak, right? Now, moving on to cash flow. So cash flow is pretty good, right? The cumulative cash flow here is about 16,224 CR versus a profit of 15,924 CR. So I mean, the company is able to convert its profits into cash. Those are not just accrual profits; those are cash profits. Now, cash flow from investing and cash flow from financing. So we start with investing, right? And so as you can see, the company has been continuously investing in its assets, right? Because it needs to invest in order to grow, right? And you could see the trend here is that the non-current assets are increasing as well. Now, the cash flow from financing is in consistent outflow and most of it is attributable to dividend payments, right? The company has raised very slight borrowings as well and there have been slight repayments of borrowings as well. But majorly the amounts here are related to dividend payments. So as you can see that the company has constantly paid dividend in each of the last 10 years, right? And there is another interesting thing that I want to share with about CFO, CFI, and CFF, but we'll talk about it at the end because it's such a good thing. Now, equity. So equity, if you look at the broad balance sheet position, so equity, assets, and liabilities, so equity has grown at a healthy rate. Assets have also grown at a healthy rate. And if you look at here with respect to specifically with respect to the current assets, the growth has been more or less in line with revenue. The growth in current liabilities is even lesser. So you can understand the net changes in working capital, the growth here, which is current assets less current liabilities here, it's slightly greater than revenue or even PAT for that matter, but I think that's understandable. The non-current assets have increased by 5.5 times over these 9-10 years, right? And most of it seems to be funded by equity, which I'll come back to later. And you'll see that the book value of equity has gone up by 4.6 times in the last 9-10 years, right? So that is pretty good. Non-current liabilities, they're not really significant except for an increase here in these 2 years, right? So there seems to be some increase in non-current liabilities. It might be attributable to borrowings. If the company has raised borrowings, that's something I'll have to check. But it could also be related to other non-current liabilities as well. But it has been a slight increase here, but still the leverage position is very, very comfortable and the company has more than sufficient equity. So it doesn't really seem to be a cause of concern, right? Okay. Now we've also talked about the financials and we've seen the growth as well. So now let's talk about the metrics, right? The key metrics, starting with return on capital and return on equity, right? Now, the return on capital and return on equity, the minimum here for return on capital is 28.4% and the minimum for return on equity is 22.3%. These are fairly good numbers, right? So this is something that is very, very good, right? But what the concern is here is that the trend of return on capital and return on equity has been declining, right? So it is consistently declining. And I think that's slightly understandable because of the fact that during the initial years, the growth was pretty solid. And as the company's size also increases, then it also impacts, right? Because the capital base has also increased. But the overall trend has been declining, but still it is pretty solid, right? Because if you look at the FY19 numbers, then FY19 numbers are also the minimum numbers, right? So still it's very comfortable. So I don't think it's really any cause of concern at this point of time. Now let's look at the margins, right? Now we'll break down the return on capital and return on equity into margins and asset turnover or capital turnover. So if you look at the margins, then the margins slightly declined during a period here, but then they shot up here and they've been more or less been maintained, or they've slightly declined, but still very high, right? So FY20 margins are more or less, you could say, higher than what it was 10 years back. And the same thing can be seen with PAT, right? So PAT margins declined very slightly here, right? So till this point, it's about a decline of 1 percentage point. Then it again increased, and here it has been the greatest actually. So if you look at the margin, then the max margin is right now. So I think that's a good sign. Okay, so now although the return on capital and return on equity have declined, but a component of it, which are the margins have actually slightly improved, or if you could say maintained, right? But why have the return on capital and return on equity declined? The answer we'll find with the asset turnover and capital turnover, right? So the capital turnover has also been on a declining trend, right? As I said, the capital base increases, and then the company is also finding it slightly challenging to grow in the recent years, right? So in the last 5 years, when the revenue growth wasn't so good, you could see that the capital turnover has fallen below 2 for the first time, right? But still, the company is able to generate 1.72 rupees of revenue for 1 rupees of invested capital. So I mean that's pretty good still. And similarly with assets, you'd see a broadly declining trend as in assets as well. Obviously, the trend is not as strong as it is in capital because asset is a larger base, right? So you'll see that the trend is again declining, and this is probably this is not the lowest. 1.19 is the lowest here, which was in previous year, and here 1.72 is the lowest, right? So slight causes of concern. Not exactly causes of concern as yet because these are still pretty good numbers that the company is putting up, right? So it's still generating more revenue versus the capital base or the asset base it has, right? But as the growth resumes, then I think we can expect these numbers to further improve. Now, asset by equity, which is basically the financial leverage sort of measure, it has continuously declined. So even though we saw that the company had probably issued debt or the sudden increase in non-current liabilities in FY19 and FY20, but still in FY20, the financial leverage is at its minimum, right? So I mean, so that basically means for 1.59 rupees worth of assets, 1 rupees of it is financed by equity, and the remaining 0.59 is financed by liabilities, not non-current liabilities, but overall liabilities. CFO by PAT, we've already talked about it. So I think it's a pretty solid cash conversion as well because the cumulative CFO is greater than cumulative PAT, right? Now, before I talk about net CFO, I want to talk about current assets and current liabilities. So as we talked about it earlier, the growth in current assets has more or less been in line with the revenue. But obviously the current liabilities have been in control, so which means that the net figure has witnessed a slight higher increase, but I think that's pretty fine. Non-current liabilities to equity, very low, very minimal. So it has a very good solvency position. Okay, now let me come to the thing that I found most interesting about this specific company, which is the net CFO position. So the net CFO position is basically cash flow from operations, less cash flow from investing and cash flow from financing, right? So if you remember here, then you'd see that the cash flow from investing and cash flow from financing are negative numbers all throughout, right? So the most interesting thing here is that if you look at the net CFO position, so which is basically cash flow from operations less the investing and financing outflows, if you find here that operating cash flows are nearly sufficient, in fact more than sufficient to cover for the investments, reinvestments that the company makes, and also for the dividend payments that it makes to the shareholders, right? So here is a negative 12, here is a negative 13, then it's been positive for a few years. Probably this is the only year where it was significant, but I think the company made a significant dividend payment here as well. And again, it is a high positive number, and here again it is negative. And if you look at the total comes around to about 197 CR, right? And I'll show that again here, which is more comfortable. So the cumulative cash flow from operations is about 16,224. The cumulative reinvestments or the net reinvestments are almost 7,000 crores, and this is almost 9,000 crores, right? So it is more than sufficient to cover. And this is the thing that I found most fascinating, because what it basically means that the company is generating enough cash to cover for the reinvestments that it require and also make continuous dividend payments, right? So that is something that you don't find very easily across companies, right? Okay, so now let's wrap this up with the highlights. So revenue, EBIT, and PAT have not fallen in any year, and this is a fantastic thing, right? Growth in PAT is greater than growth in EBIT, and the growth in EBIT is greater than the growth in revenue. That is something we talked about. We also talked about the low growth, slight cause of concern at this point of time in recent years. So revenue out of the 4 out of the last 5 years has been slightly poor. EBIT 3 out of the last 5 years, and PAT 2 out of the last 5 years, right? CFO's percentage of PAT has been greater than 100% in 5 out of last 10 years, and cumulative CFO is greater than cumulative PAT, right? CFO has been slightly more increasing and decreasing versus PAT, but that you can understand because of how the operating cycle works, right? Now, continuous reinvestment into assets, the 5.5x growth in the non-current assets, right? Most of it would be fixed assets, and nearly all of it is funded via equity, right? As we saw as well, and which has grown, the book value of equity, which has grown by 4.6x. So that's a good number as well. Return on capital, return on equity, very solid. Return on capital more than 25%, return on equity more than 20% in each of the last 10 years. The trend is decreasing, but I think it should again be on the uprise once growth comes back, right? EBIT margin greater than 15% and PAT margin greater than 10%. So the broad trend has been slight fall and then again resurgence here as well. And you can understand that the margins are not so high, right? But the company is still able to maintain and improve its margins as well. So that is a very good thing. Asset utilization, capital utilization, very solid, right? Again, the trend is slightly decreasing, but that depends on how growth comes back or not. So, but still, these at this point as well, these are very healthy numbers. So, what's really happening here as well? What's happening here is that the company had very strong performance from FY11 to FY14 and to a certain extent FY15 as well, and that is why we feel that the current performance is not so good, right? Increase in non-current liabilities in recent 2 years, but financial leverage has declined, so not really something, not something very significant. This is the main point here. CFO is sufficient to cover cash investing outflow, that is reinvestment, and payments to shareholders, which are dividends. This is over and above any stock price returns that the shareholders have gotten. So that is very solid. So what's the conclusion here? The conclusion that I was able to make here is that the company has a very strong financial performance, very strong financial position, but currently it's finding it challenging to grow. Now this would be very interesting to see in FY21 because of the pandemic, the restrictions on selling, but this might have also resulted in the consolidation of market share. It already holds a commandable market share, is the market leader, but if the market share further increases, then let's see if it can grow via that. So that is more or less it that I wanted to share about this company. If you found this helpful, please let me know. Please share it with someone who finds financial analysis interesting. Quick reminder, please do not make investments based on this. This is just a way to identify if this company is worth researching more, and I think it is, right? So that is pretty much it for now. If you have any questions or if you want to discuss the company in detail, please let me know. If you want to receive this analysis and much more straight to your inbox, then you can sign up using the link in the description. That's it for now. I'll see you again tomorrow with another company. If you found this helpful, please don't forget to share and subscribe. Thank you so much.